Hello and welcome to the session 3 of our Series 7 exam overviews by Passing Score. In this video, we'll be going over equity issuances. There's a few different ideas that we'll have to get through, including public offerings, red herrings, tombstones. You'll know what all of these mean by the time we're done. Unfortunately, there's a lot of rules going on in this section. You'll just have to get used to the idea first, and that'll make memorizing the specific lists a little bit easier. Let's start with the public offering or primary offering. These have to be registered with the SEC with a few exceptions, including government securities, government agencies, nonprofits are exempt. Corporate debt with a maturity of 270 days or less are also exempt. These are known as commercial paper and allow corporations to offer short-term financing inexpensively. Also intrastate offerings, which we'll go through a little bit later, and U.S. banks or trusts, small business investment companies, also exempt. The issuance goes through what's called an underwriting process with the help of an investment banker who facilitates with the issuer and offers distribution out into the market. The agreement between the issuer and the investment banker is known as the underwriting agreements. The different types of underwriting agreements are really how the risk will be distributed between the issuer and the investment bank. In a firm commitment, the underwriter takes all the risk, essentially acting as a principal in the issuance. In a best efforts agreement, they don't take any of the risk. They're just acting as an agent, and any shares are returned back to the issuer if they can't meet the price that they want. So just remember the agency versus the principal idea, and there's different kinds of features in these agreements as well. But the main thing is pay attention to the risk that each of the parties is undertaking. Syndicate is just a group of underwriters who work together on an issuance. There's a lead or managing underwriter and then part of the underwriting group, and together they make up the syndicate. This is to spread the risk and offer better distribution for the new issuance. The underwriting group can also contract with additional broker-dealers and who aren't part of the underwriting group, and those are the selling group. These are people who take a smaller commission but don't take any of the risk with the issuance either. There's two ways that the underwriting group can take the risk. The Western or divided account, in which each member of the underwriting group just has a risk for the shares that they're allotted to share. So we can think of this as a lone Western cowboy way to try to remember this, that each one has just an individual responsibility. And then there's the Eastern or undivided account, in which the entire group is going to take their proportional risk and responsibility for any shares that aren't sold. The underwriting spread is how the members of the selling group and the underwriting group get paid. They'll take a cut of the shares that are sold. In this example, the share price is $100, the spread is $7, and the proceeds going back to the issuer are $93. Now that $7 is spread a couple of different ways, beginning with the lead manager who gets a cut of every share that's sold. In this example, they'll get 20% of anything that's sold, so $1.40 for each share. Meanwhile, the underwriter, a member of the underwriting group, gets an underwriting fee, or their 20%, for any part that they're responsible to sell as well. Members of the selling group, which are not part of the syndicate, get what's called a concession fee. This is the commission that they get, or whoever sells the shares, get for selling those shares. The takedown is what a member of the underwriting group would get. This is the underwriting fee plus the concession fee, in this case 80% or $5.60 for selling the shares. The one way to remember this is using the acronym MUCT, the manager's fee, underwriting fee, concession fee, and then the takedown, which is a total of the two above it, the underwriting and concession fee. So you can see that the percentages go up as we go through the list. there are certain rules in order to protect consumers and also to control the shares that are being issued. There are something called an affirmative statement, in which the client is verified that they have the ability to take the risk of a new issue. The written or electronic statement saying this that's verified every 12 months, and then a record of that's kept for the past 3 years. And a restricted person cannot have a beneficial interest either. So one way to remember this is AWR, affirmative statements, written statements, and record of that statement. That's part of the new issue rule. A restricted person is defined under the new issue rule as really anybody associated with the equity issuance, including members of their immediate family as well. This can be the accountants, lawyers working to advise on it, anybody with that's part of the member broker-dealer or investment banks, and members of their family as well, and including anybody that has a 10% or greater ownership of a broker-dealer is automatically a restricted person. So we can remember this as being all the associated people with the issuance, as well as 10% owners of broker-dealers. One other thing with new issue rules is that it exempts all debt offerings, secondary offerings, private offerings. We're just mainly focused here on new equity issuances. So we don't have to worry about REITs and mutual funds and other kinds of offerings. The registration statement is the form that's filed with the SEC to get approval for the issuance into the market for the IPO. This includes all the basic information about the firm, the issuer, the description of their business, bios about the directors and officers, disclosures of ownership for significant owners, 10% or more, and the underwriters and their holdings of the issuer as well. Once this is filed, there's a 20-day cooling off period in which a process called Blue Sky begins. This is the registration of the issuance in all the states where the securities are going to be offered. When that Blue Sky or 20-day cooling off period is over, there's a due diligence meeting between the issuers and underwriters to make final verifications before the next step is taken. So remember, there's a Blue Sky period, a registration, which is done during the 20-day cooling off period. A red herring is the preliminary prospectus, which is used to generate awareness of the issuance and find out if there's a lot of interest, if this is going to be a hot issuance, and who can be possible buyers of the new issuance. It's called a red herring because the prospectus form has a red band along the side of it. This is not used for any kind of orders. It's just to find out who's interested in it. In fact, there's an SEC comment saying that nothing in the prospectus, this preliminary prospectus, the red herring, has been verified or guaranteed yet because they haven't done their approvals as of yet. So this is for indications only, not for orders or general ads. They'll go to institutional and large investors with the red herring. The Tombstone agreement is the only kind of ad that's allowed, and it's done after the registration is effective. It's called a tombstone because it's very plain, has a thick black border, and it contains only the most basic information, as well as the standard clause, which you should know, called a not an offer to sell or a solicitation of an offer to buy. The offering is made only by prospectus. You should know this is a lot of times this will be tested on the exam. And again, this just has very basic information, and it's only after the registration. An accredited investor is important for a lot of the private equity issuances, which we'll get to next. These are mainly large institutions, a lot of assets, and individuals with $200,000 or more of income, or $300,000 for joint filers over the past 2 years. Either that or $1 million of liquid assets, which means excluding your primary home. So we'll try to remember this by remembering that partnerships have to have greater than $5 million in assets, that individuals have to have greater than 1 million, and then 300 of income and 200 of income for the individual. So 5, 1, 300, 200. The SEC Rule 144 handles restricted, which means shares that have not been registered, private or companies that have not gone public, so they're private shares, or control stock. These are shares that are held by insiders in a company, so to control insider trading. So they have these types of holdings, these private shares and these insider shares have a lot of rules built around them. Now I won't go over all of these, but you should know these because they will be tested on the exam. Or I should say, Rule 144A is a different kind of exemption. This is for large institutions so that they can trade between themselves, and since they can bear a lot of risk and they don't have to register these shares and go through a lot of delay and cumbersome process when they're two very assumed to be sophisticated types of investors. So that eliminates the holding period, which would normally be the case for Rule 144 trades. QIB under Rule 144A is a qualified institutional buyer, which has $100 million or more of securities, not of their own company. It can be a domestic or foreign institution, but they do have to have audited financial statements. So this eliminates a lot of the delays that would occur if these large institutions had to register their private holdings and trade them between themselves. Rule 145 has to do with transfers of securities for certain types of transactions, mergers and consolidations. Now, the typical things like stock splits and reverse splits don't count. Those are normal type of corporate transactions. But these are still subject to the new holding periods, similar to Rule 144 restrictions. But shareholders who have public shares or registered shares are not affected by these restrictions at all. Finally, there's Rule 147. This is an exemption from registration for intrastate offerings. In this case, the issuer has 80% of their revenues, 80% of their assets, and will use 80% of the funds from the equity issuance within the states. In addition, all of the investors putting their money into this issuer have to have their principal residence within that same state. So if you meet all of these qualifications, you don't have to register with the SEC. And we can remember this easily with our 3 80s, 80 for revenues, assets, and funds used in the state. And remember that all investors have to be in that state as well. A non-resident can buy after the issuance has been held for 9 months. So those are the major rules with equity issuances. If you have any questions or comments, please feel free to email me at john@passingscorefinance.com, and good luck on your exam.